Hi, my name is Ben Shepard and I'm the editor of Global ETF Profits. The markets have been in quite a sell-off for the past month. Since the flash crash of May 6th, a lot of analysts, particularly the technicians, are beginning to wonder if maybe we won't retest those lows we saw in February of last year. Mainly as worries over the European debt situation continue to swirl. And then there are some concerns that maybe the economic recovery here in the U.S. won't necessarily be as strong as many had hoped. I personally fall into the camp that this is really more of just a correction rather than a real turn in the markets. In any recovery, you're going to have your ups and downs where, some months the data is going to be really just spectacularly good, and then you're going to have other months where the data is just not going to be that impressive. And I kind of feel like we're just in a short-term bump in the road where the data just isn't quite as impressive as it could be. So that begs the question of what's going on with the American consumer, accounting for about 70% of our economic activity. If the consumer's not spending, the reverberations of that are felt right on through the value chain. But some interesting data there. Consumer spending has actually been on the uptick, and we've seen that reflected in some reports out of some major retailers. A lot of folks like Macy's and Nordstrom's and some of the higher end retailers are reporting improving same-store sales, which is a pretty good indication that perhaps consumers are starting to trade back up, reversing that phenomena where we saw a couple of years ago where they were trading down, where the former Macy's shoppers were now going to Walmart. So that's a really good sign. Another positive sign, though you can get a little wishy-washy on this number, is the savings rate has fallen. 3 years ago, 4 years ago, if you looked at the savings rate in real numbers, it was actually negative, where consumers were financing their purchases. Then at the height of the crisis, it had shot up to around 6%, and as of the latest release out of the Commerce Department, right now the personal savings rate is right around 3%. So it would be nice to see a little more savings going on than that, but at the same time, it's a really positive indicator that consumers are feeling more confident in their futures and their current situation. As the pace of layoffs has slowed, folks are less worried about losing their job. The situation in real estate markets in a lot of areas of the country are beginning to look up, and that's led to folks opening their wallets again, and that's had a really positive impact on spending. Even as the savings rate may be falling, the deleveraging process is still continuing apace. The Federal Reserve tracks what it calls the consumer debt service ratio, which is basically the percent of disposable income that Americans are having to use to make debt payments. And we've really seen that fall over the past year. It's gone from about 13.9 to it's now down to 12.6. And last year, total consumer credit outstanding fell by 4.4%. And that's not been a straight line down. It's been a bit of a fluctuation month to month, but the general trend is downward. So that's a really positive indicator as well, because that shows us that while spending is going up, folks aren't putting it on credit cards. They aren't borrowing against their home equity lines of credit. They're not using debt to finance their purchases. They're paying for their purchases out of savings. And that's just a really terrific sign, because that means the level of spending is largely sustainable. So that bodes well for a number of companies. But right now, my favorite retailer is Guess. The ticker on that is GES. A lot of folks probably know Guess for their really racy advertising, particularly in the Condé Nast publications, where perhaps their editorial decency standards might be a little lower than some other publications. I know if you open an issue of Vanity Fair, you'll see you'll probably see more skin than fabric, which kind of makes you wonder what Guess actually sells. But they still have a hugely popular line of jeans. And they've been expanding into other apparel, fashion accessories, sunglasses, belts, some jewelry, tops, the whole 9 yards. Guess has really become a one-stop shop for the teeny bopper fashionistas. But Guess isn't content just to leave their brand there. Guess has expanded their line of offerings to include some lower priced, not quite such high fashion pieces to appeal to the younger, more cost-conscious set. They've also launched a new line to appeal to women between 25 and 40, which is a big bracket for the apparel retailers because those are the women with the disposable income. Guess is also really ramping up their international expansion. Next year they're planning to open several new stores in Russia, an area where they don't really have a whole lot of presence right now, and most of their presence is through licensing deals. So that's going to be a major plus. They have really ambitious expansion plans for Asia, which is another key market for these consumer-type companies. So over the long haul, I strongly suspect that we'll see earnings at Guess probably grow between about 7 and 13% over the next 2 to 3 years. If you don't want to lay your wagers with just a single name, there's the Consumer Discretionary Select Spider XLY that includes a pretty broad array of the consumer discretionary set. Apparel retailers, more general merchandise retailers, food. Really, it covers the whole gamut of the sector. And I think that's a really solid bet right now too, because this improved spending trend will bleed through right on down the line. So again, my name is Ben Shepard, and I'm the editor of Global ETF Profits.